Do you want to grow your money regularly at minimum cost over time? Hi friends, investing in index funds helps you attain major investment goals and enjoy financial freedom. Hello and welcome. I am Anirudh from Clear, India's largest tax and financial service platform. At Clear, we have assisted 6 million tax filers so far. If you have not already, do subscribe to our channel to support us. Index funds are a portfolio of stocks that impersonate or mimic the performance of a stock market index such as the Nifty 50 or the Sensex. The fund manager won't play an active role in picking the stocks to create a fund's portfolio. Index funds invest in all stocks that make up the stock market index it tracks in their respective proportions. For instance, the BSE Sensex comprises 30 of the largest liquid stocks on the Bombay Stock Exchange. If the weight of a stock within the index changes, the fund manager must buy or sell stocks units to have its weight in the portfolio aligned to that of the index. However, index funds don't always generate the same returns as the stock market index it tracks because of the tracking error. Tracking error happens because of the mutual fund expenses, problems with buying and selling the underlying index stocks, and sometimes index funds are forced to hold cash. Broad market index fund attempts to replicate a large segment of the stock market. For example, the Nifty 500 is a broad market index as it gives investors exposure across sectors and market capitalization. Market capitalization index funds comprise of stocks based on market capitalization. For example, the Nifty 50, Sensex, Nifty Next 50, Nifty Small Cap 250, and Nifty Mid Cap 150 are prominent examples of indices that are market cap weighted. In an equal weight index funds, every stock in the index carries the same weight. Suppose the index under consideration is the Nifty 50, then all companies are weighted at an equal 2%. Sector based index funds focus on businesses belonging to the same sector or industry. For instance, there are sector based index funds in technology, banking, infrastructure, healthcare, etc. International index funds concentrate on businesses outside India. For instance, there are funds tracking multiple US specific indices such as NYSE FANG Plus Index, the S&P 500 Index, and the Nasdaq Index. You must go for index funds if you want returns that match the stock market. For instance, if you invest in a Nifty 50 index fund, you get returns in line with this index. You get broad diversification across sectors, industries, and market capitalization depending on the type of index fund. For instance, suppose you invest in an index fund that tracks the Nifty 500, you diversify your portfolio across many companies by investing money into just one index fund. You can invest in index funds if you prefer a low cost investment. As the fund manager doesn't actively trade to earn market beating returns, you incur lower management fees. Index funds have a lower expense ratio than actively managed mutual funds. It is the cost of managing your investment. For instance, index funds tracking the Nifty index had an average expense ratio of 0.25% under direct plans. SEBI allows mutual fund houses to charge an expense ratio up to 1% in index funds. However, most mutual fund houses charge far less than this cap. Check these parameters to choose the best index funds. You could check the performance of top index funds based on the absolute returns over a period of 5 years. It helps to pick index funds which have an expense ratio below 0.3%. You could choose index funds with a tracking error of 0.06% to 0.15%. Try to pick index funds with assets under management of above Rs 500 crores. The following table shows why investors prefer index funds. Over 5 years, from June 2016 to June 2021, 82.7% of large cap funds, 76.2% of small and mid cap funds, and 69.6% of ELSS underperformed their respective benchmarks. Wouldn't it be better to go for index funds where you can at least get returns that match the benchmark stock market indices? I hope by now you've understood what index mutual funds are. Comment clear if you're clear or drop your questions if any. The investment objective of the Navi Nifty 50 index fund is to attain returns equal to the Nifty 50 stock market index. The Navi Nifty 50 index fund focuses on well established big companies which are part of the Nifty 50. It is suitable for investors seeking returns that match the Nifty 50, the benchmark Indian stock market index. It represents the weighted average of 50 of the largest Indian companies listed on the National Stock Exchange. Investing in the Navi Nifty 50 index fund is an excellent option if you seek a low cost investment as it has an expense ratio of 0.06% against the category average of 0.27%. You may invest in the Navi Nifty 50 index fund if you have an investment horizon of 5 or more years. As Navi Nifty 50 index fund is open ended, you can invest at any time in this fund. The Navi Nifty 50 index fund scheme has an asset size of Rs 303 crores. The following table shows sectors holding in Navi Nifty 50 index funds. The following table shows advantages of investing in Navi Nifty 50 index fund. Navi Nifty 50 index fund has one of the lowest expense ratio among index funds in India. Navi Nifty 50 index fund has very high risk as shown in the riskometer. You can invest in the Navi Nifty 50 index fund if you seek returns that match the Nifty 50 at one of the lowest expense ratio. Around 86% actively managed funds investing in the top 100 companies of India gave lesser returns compared to Nifty 50 between June 2020 to June 2021. As Navi Nifty 50 index fund was launched in July last year, you may consider waiting until it establishes a track record of performance. Thank you for watching this video. If you have any queries related to investments and taxes, please comment below. We will address them as soon as possible. Stay tuned for more updates and don't forget to subscribe our channel for cryptocurrency related content. Take care and goodbye.